There's a lot of things going on in different data points, but I do think that the incoming data, in particular the more important data, it still shows the economy doing well. Non-farm payrolls at 272,000 was good. Now the consensus expects 185 for next Friday. That's not bad either. We have the Atlanta Fed GDP now expecting GDP growth in the second quarter of 2.7. That's not bad either. Jobless claims are moving exactly in line with the seasonal patterns that we normally see. And finally, if you look even at that weekly Red Book same-store retail sales, it's also chugging along very nicely, together with car sales, which should have been down, but is also still doing very nicely. So it's a little bit difficult at this point to see, and I think Mohammed agrees with this, we're not seeing the economy fall apart. It is just the case that a lot of the incoming data just still continues to point to an economy that has two tailwinds from easy fiscal conditions, meaning we still have support from the CHIPS Act, the Inflation Reduction and Infrastructure Act, and we also still have easy financial conditions providing a tailwind. So overall, we still see steady growth for the next several quarters.
So I can't handle all of the people who are so casual, everyone laying their hair down on this Friday. Before we get back to you, Mohammed, let's get to you, Torsten, on the point that Mohammed was making, that the balance of risks right now is more seriously tilted to the Fed making an error by not cutting quickly enough because of weakness that you're seeing in the labor market and because of a real concern that you're seeing among the average household.
Yeah, so there's certainly some distributional issues. Those who owe money, meaning those who have a lot of leverage in the household sector, those who have a lot of debt, they generally have been hit harder by interest rates going up. That generally tends to be lower income households. Higher income households have, on the other hand, been benefiting from stock prices going up, home prices going up. The cash flow from fixed income has not been better in decades than it is at the moment. That's why in the Fed distributional accounts, for the 80 to 99 percentile of the income distribution, you're actually beginning to see cash balances go up in the last several quarters. So high-income households are still providing quite a nice tailwind overall to consumer spending. But you're right, Lisa, there are some distributional aspects. But overall, when you look at the outlook for consumer spending, including the data we just got this morning, income is still very strong. And you also have on top of that, low unemployment rate at 4%. It's just that's very difficult to see that slowdown that the Fed is anticipating.